US-China rare earth tensions. Can diplomacy prevent a global supply shock? In recent weeks, the trade tensions between the United States and China have reignited, this time centered on rare earth elements and magnetic materials, the backbone of modern technology. As both sides prepare for a high-level meeting in Malaysia between U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng, the world watches closely, hoping for de-escalation before a full-blown trade war returns. The core issue: rare earth dominance. China currently controls over 70% of global rare earth production and nearly 90% of the processing capacity. These minerals are essential for producing high-tech goods such as smartphones, electric vehicles, fighter jets, and renewable energy systems. Recently, Beijing tightened export controls on these materials, introducing new licensing rules even for products containing trace amounts of rare earth elements. Washington responded sharply, threatening to impose 100% tariffs on Chinese imports unless Beijing rolls back the restrictions. U.S. President Donald Trump described the proposed 100% tariffs as unsustainable, acknowledging that while the U.S. must protect its industries, prolonged trade barriers could harm both economies. Beijing, on the other hand, insists that its export measures are legitimate and necessary for national security, denying that they are meant to provoke a trade war. Chinese officials say they are open to dialogue but will take appropriate actions if pressured further. Industries at risk. The ongoing tensions threaten several major industries. Technology sector, chip makers, smartphone producers, and electronics manufacturers could face rising costs as the supply of critical minerals tightens. Electric vehicle (EV) industry. Rare earth magnets are key components of EV motors and batteries. Any disruption could slow global EV production and innovation. Defense industry. Rare earth elements are indispensable in radar systems, missile guidance, and aircraft engines, making the issue not only economic but also strategic. Global supply chains. Companies seeking to diversify away from China may face higher costs and delays as alternative sources remain limited. China appears determined to use its dominance as leverage while promoting its own domestic industries. By controlling exports, Beijing ensures that its high-tech manufacturers maintain a competitive edge. The United States, meanwhile, is investing heavily in alternative supply chains, mining projects, and processing facilities, from Australia to Africa, aiming to reduce dependency on China. This strategy is part of a broader effort to decouple critical supply chains from Chinese influence. The International Monetary Fund, IMF, and World Trade Organization, WTO, have both warned that rising tariffs and export restrictions between the world's two largest economies could destabilize global markets. Prices of consumer electronics, electric vehicles, and renewable energy technologies may rise worldwide. A sustained conflict could also slow global economic growth, particularly in Asia, where manufacturing hubs like Vietnam, Malaysia, and South Korea rely heavily on components from both China and the U.S. Can Malaysia talks ease the tension? The upcoming meeting between Bessent and He Lifeng represents a critical test for U.S.-China diplomacy. Both sides claim to seek constructive engagement, but deep mistrust remains. Analysts believe that while a short-term compromise may be reached, such as partial tariff rollbacks or export quotas, a lasting solution will require rebuilding strategic trust, something that has been eroding for years. The rare earth dispute goes far beyond trade statistics. It's a battle for technological and geopolitical dominance. While both Washington and Beijing recognize that an all-out trade war would damage their economies, national pride and strategic interests make compromise difficult. If the talks in Malaysia fail, the world could be heading toward another wave of supply chain shocks, higher production costs, and renewed uncertainty in global markets. For now, the global economy holds its breath, waiting to see whether dialogue prevails over confrontation.